Okay, let's get started, folks. How are you? My name is John O'Donnell. I'm going to be your moderator today. I'm the Chief Knowledge Officer, Director of Research at Online Trading Academy. How many of you have heard of Online Trading Academy? We are probably the very largest trading school in the world. Happen to be located in Irvine, California, but we have centers in 35 cities across the world. Probably have one near you. Just visit our website, tradingacademy.com. My email address is john@tradingacademy.com, and I would encourage you to write that down because I'm going to send all of you, if you email me at the end of this seminar, a special link to a series of free webinars that our team has produced. I'm also the co-host of PowerTradingRadio.com. Have any of you listened to our radio show? If not, go to that website. You'll see lots of information there. We also stream it off the FX Street website. They distribute Power Trading Radio as well. One of my favorite is Will Rogers. For those of you that are not familiar with Will Rogers, he's a great humorist during the 1930s. He's one of the most popular comedians in the world, made his fame in radio. He tells us that history has demonstrated that the most noble winners usually encounter heartbreaking obstacles before they triumphed. They won because they refused to be discouraged by their defeats. I think that relates to Forex trading. I think it relates to stock trading, futures trading. Many of you have had heartbreaking defeats as you've self-financed your own learning curve over time. Yeah, it does seem to be the theme of the day, doesn't it? You know, Sir Winston Churchill had something to say, and I'm a history buff, so you'll see scattered throughout my presentation today a series of quotes from various dignitaries. He said, "The inherent vice of capitalism is the uneven distribution of blessings, while the inherent virtue of socialism is the equal distribution of misery." If you're in this room today, you're probably a capitalist because you want to trade various forms of capital. FX Street happens to be one of the leading foreign currency portals in the world, and I'm going to talk today about what I see taking place in the markets, and I call it the perception versus reality environment we live in today as the global world is transitioning to the new normal. So my email address, and for those of you that didn't write it down, please do so, is John, John, @tradingacademy.com. But the world is transitioning to what PIMCO calls the new normal. Who is PIMCO? Well, PIMCO is one of the very largest bond trading firms in the world. They're owned by the Allianz Insurance Company out of Germany. They happen to be located next door to Irvine, California, where I'm located, in a little town called Newport Beach, California. They have about $1 trillion position in bonds. And they tell us that the world is transitioning to the new normal. And my goal today is to give you some transparency on what the new normal looks like, and especially in the developed world, and how it's going to impact the price of assets, including currencies. Now, we believe, ladies and gentlemen, that this transition to the new normal is going to be led by what we call the Globalization 3.0 deleveraging credit purge cycle. Now, what do I mean by deleveraging? Well, we believe that the mother's milk of capitalism is the global credit market. Credit instruments are unique instruments in that they are both assets and liabilities, depending upon whose balance sheets they happen to be located. And the world happens to be deleveraging right now. Yes, I know that various sovereign governments are printing money like drunken sailors, but that's just a small part of the overall balance sheets. Matter of fact, we'll take a look at the hard data today on the private sector versus public sector balance sheets and how the purge in the private sector is impacting federal debt. The world is going through, for decades, a growth of capacity, and we've just built too much capacity, too many burger joints, too many shopping malls, too many office buildings, and financed with too much debt. And what's happening is the credit is being purged off those balance sheets, quite frankly, at an alarming rate, and it's having a very big impact. So the essence of the not only just U.S. economic crisis, but the whole developed world's economic crisis. And remember, the world, especially the credit markets, are remarkably interconnected and resilient and very, very sensitive. And if you don't believe that, just take a look at what's happened to the credit markets in Western Europe. But these are the three big rocks that we see are the essence. We have an implosion of global trade going on, and there's a huge imbalance between trade in the world. And it's really going to create, we believe, a lot of volatility for various asset prices. And I'll try to spin this story from a currency perspective as we go through it, but I want to lay the foundation of what we perceive to be the root cause of all this volatility in the world today. And not only financial volatility, but geopolitical volatility as well. And we'll have a little statement about that later on as well. What's also driving the second leg of this three-legged stool is the implosion of the household balance sheets, not only in America, but also in Western Europe. And that debt is being purged off the Americans' balance sheets, some of it voluntarily, some of it involuntarily. And it's causing the U.S. government to continue to run big deficits. But that's just a small part of the overall debt situation that we need to deal with. And then the third leg of that triangle, of course, is the banks. Does anybody in this webinar today believe the banks have come clean on their accounting? I mean, come on. With the issues of mark-to-market accounting, etc., does anybody believe they've come clean? Give me what is your belief? Are the banks coming clean on their accounting? I mean, look at the banks in Western Europe. Look at the banks in America. What all this has led to across the developed world today is anemic CapEx spending. Now, what is CapEx spending? CapEx spending is basically a business expanding their capacity, their infrastructure to produce more widgets or goods and services. Now, in the United States, we see that industrial capacity today is running at about 75%. But yet, even though we have massive surplus capacity financed with too much debt, we're still finding that industrial output is still up in the 82 percentile area. So we're producing more output with less workers and less use of the capacity we have in place. The net effect is there's no need for the developed world to expand their capacity to produce, especially when you look at the fact that we are losing jobs. These are percentage job losses since World War II in America, and you can see, and if we have the various colors here, in red is where we are today, is that we're not creating any jobs in America. Now, since the recession has started on Bush's watch, we've lost about 15 million jobs. But yet, industrial output, although it shrunk from its peak, is continuing to stay relatively stable. And this, of course, ladies and gentlemen, is because the previous decades, too much capacity to produce too many goods and services that, quite frankly, the world is not capable of absorbing right now. And that's why there's not a lot of price inflation. The Consumer Price Index, we'll talk a little bit about that a little bit later, is telling us there just is really not a whole lot of inflation. So much capacity financed with too much debt. And it's going to take us some time to work off all this surplus capacity. So it's going to lead us in a moment to the most important debate that you and I need to have as currency traders, and I'm primarily a currency and equity trader, which is what's going to happen to the purchasing power of the U.S. dollar. Are we going to have inflation or are we going to have deflation? and we're going to do something that's unique. We're going to define our terms, and that's rarely done in this world. So you're going to have all the opportunity to vote here in a moment. And going forward, is our biggest fear inflation or deflation? And you're going to have the opportunity to vote. If you'd like to vote now, that's fine. But you're also going to have the opportunity to vote at the end of my presentation. And when you look at the data, you very well may have the opportunity to reverse your vote. So go ahead and put in your vote right now. We've got about 47 people that are queued up watching this event. Go ahead and vote right now. Are you going forward an inflation-sensitive trading plan or a deflation-sensitive trading plan? Go ahead. Where do you stand in this debate? Because we're going to get into it hot and heavy today. All right. Let's take a look at the constant dollar of the U.S. stock market since 1900. Rarely do you see charts adjusted for inflation. That is, the purchasing power parity of in this particular case, the Dow Jones Industrial Average. You'll note, by the way, when adjusted for inflation, the Dow's 1982 low right here reached a lower level than the Dow was priced way back in 1900. Take a look at this. This is quite amazing. And other than the bull market we've had since 1982 through 2011, you can see that from roughly 82 years, adjusted for inflation, although we've had a very volatile priced market, in purchasing power parity, that is, how much goods and services will the Dow buy me at the end of the day, the U.S. stock market's gone nowhere for roughly 82 years. And then when adjusted for inflation, these periods right here in blue, which apparently look sideways in a nominal chart, were actually, when adjusted for inflation, deep secular bear markets. And these were very long periods of time, complementing the periods of time when we had some secular bull markets. So you and I as traders need to be prepared for both. And that's what the data shows us. Now, John Kennedy, probably one of the most popular presidents in the history of the world, said right before that fateful trip to Dallas that the great enemy of truth is very often not the lies. Liars are, in fact, deliberate, contrived, and dishonest. But the real enemy of truth is myth. Myths are persistent, persuasive, and unrealistic. Ladies and gentlemen, it is a myth that inflation is permanent. Now, most of you in this room that have been voted so far are voting for inflation. And it is your belief system that inflation is the dominant trend and that it is in a permanent way of life. Well, in fact, if we measure equities priced in real terms, you can see that, in fact, the price of goods and services over time have always been remarkably volatile. Now, let me share something with you that we all need to focus on. There's a lot of myths centered around the inflation-deflation debate. And my job today is to try to bring some sanity to the debate. Now, I had the opportunity to go to a Jesuit school. And the interesting thing about Jesuits is they teach you, if you're going to get in a debate, and you have a particular point of view, and it seems to me this particular room and a lot of the pundits we see on financial television today have an inflationist point of view. But I think the most important thing you and I can do if we're going to get into a debate is to listen intently to the other side of your position. If you're an inflationist, you need to listen to what the deflation argument is. And on the contra to that, if you're a deflationist today, you need to listen intently to what the inflation data looks like. Now, the good news is we have a lot of data. And both sides of this debate position the data in a very persuasive manner to support their point of view. But the biggest mistake you and I can make if we get into a debate is to only listen to that data that supports our point of view. That's what, a market is a debate. It's a debate between a buyer and a seller. There are people that are very bullish the euro-dollar pair right now. There are people that are bearish the euro-dollar pair. And they very persuasively can argue their point of view, which will very well impact your position. So let's get into this a little bit. We have some people in the room that are telling us that the U.S. government is printing a lot of money. Yes, the U.S. federal debt is growing. This is the picture of the federal debt since 1960, and you have to be an idiot and living under a rock not to see that the U.S. government, as debt as a percent of GDP, that the debt is growing at a much faster rate. America today has about $14 trillion of GDP, and we have today about $12 trillion of federal debt. But let's look at this and there are many that forecast that we're going to have a hyperinflation remarkably similar to what the Weimar Republic went through in Germany, where people literally paid with wheelbarrows full of money. Or I had a person come to my seminar the other day that brought a $100 trillion Zimbabwe note. And I asked him, I said, it looked like a $100 bill, but it had 100 trillion printed on it. And I asked him, I said, man, I bet this note will buy you a lot of condos in Zimbabwe. He said, no, it'll buy you a chicken. I said, you mean like a Kentucky Fried Chicken dinner, KFC dinner? He said, no, I mean like that chicken that's running across the field over there. So governments have, yes, a way of diluting the currency so that it loses massive purchasing power parity. But what a lot of people are missing is the federal debt is not the most dominant debt in our economy. The most dominant debt in our economy is the non-federal debt. And if you want to know, if we believe here at Online Trading Academy that the credit market, the debt market, is the mother's milk of capitalism, and if you really want to know where the equity market's headed and the foreign currency market, you got to keep your finger on the pulse of what's happening in the credit market, specifically that component of the credit market that's not driven by sovereign debt. Now, this is the total debt to GDP profile of the United States. And let's take a look at the history of debt as a percent of GDP in the U.S. Well, from the 1870 to 1920, you can see, and by the way, the gray bars in the background are periods where we've had various recessions in America, and you can see they come along frequently. But let's take a look at this. From 1870 to 1920, debt as a percent of GDP was approximately, on average, 150% of GDP. Now, that may not mean much to you today, but in a moment I'll put that in perspective for you. Then we had the credit binge of the 1920s, right here, that led to, under Austrian economic theory, the credit purge of the 1930s. Now, the Keynesians have a different perspective on that, but we'll discuss that in just a moment. The Austrian economic theory is that credit binges always, without exception, lead to eras of credit purge. Now, look what happened after World War II. Debt as a percent of GDP for 4 decades goes back to where it was in the 1800s, at about 150% of GDP on average. Take a look at this. It's an alarming analysis for most of you. I doubt if you've ever seen this chart before. 4 decades of growing GDP relative to debt? Yes. It's a myth to believe, a Keynesian myth, I might add, to believe that you need to have a highly leveraged economy to have a growing economy. Reagan's elected right here in 1982, and what did Reagan bring to the party that created all of this? Well, he brought some deficit spending, but primarily he brought confidence. Confidence for what? Confidence for lenders to lend, confidence for borrowers to borrow and spend. And here's where we are today, ladies and gentlemen. Total debt as a percent of GDP in America is not $12 trillion. Total debt as a percent of GDP in America is in excess of $50 trillion. So if I were to take $14 trillion and multiply it by 3.69, That's where I come up with the $50 trillion number. And the most important, so if I take 50 trillion, subtract the 12 trillion of federal debt, you can see that we've got about $38 trillion of debt in America on the balance sheet of both borrowers and lenders that's non-federal. Because it's only the federal government that has the printing press to print money. So the largest component of credit in the system that is the candidate to be purged, because that component of debt users have no printing press, is the private sector or non-federal sector. Why is California in trouble? Well, they can't print dollars. Why is Greece in trouble? They can't print euros. Now, take a look at this. The impact of the credit that's being purged out of the balance sheets of the non-federal component of credit has showing us that the velocity of money is slowing. And the velocity of money, which is the calculation of the number of times that a dollar of GDP turns over in a given economy, is the primary engine that's leading this deflationary trend. So what is the U.S. economy, and what is the European economy, especially Western European? Well, they've created a bug in search of a windshield economy. That's exactly what all this decades of printing of money has taken place. And I believe that there is a question you and I have to ask. Is the U.S. following the Japanese economic recovery model? By the way, someone asked earlier for my email address. Here is my email address, john@tradingacademy.com, if you want a copy of this presentation. Let's take a look at this. How does the U.S. compare with other developed countries and underdeveloped countries or emerging countries across the world? This is sovereign debt as a percent of GDP. Now, U.S. debt is approaching 100% of GDP. We're not quite there yet. Canada's debt's about 90% of GDP. But look at Japan out here. Japan, for 2 decades, has been running these humongous deficits we're going to look at in a moment. And their debt as a percent of GDP is over 200% of GDP. Compare that to Germany, France, Italy, UK, Greece out here at about 130% of GDP, Portugal, Spain, some of these pig countries. But take a look at this one, China. China's debt as a percent of GDP is only 20% of GDP. And again, they have the fastest, if you believe the Chinese numbers for GDP growth rates, they have the fastest growing economy in the world. But they're doing it on a relatively low levered balance sheet. Now, most people would believe, if you're Keynesians, that the Chinese economy needs to have massive amounts of debt to have a sustainable growing 10% per annum rate. But the facts are, just like America in the early days of its growth, you don't need a highly leveraged balance sheet to grow. So let's learn something from the Japanese 2 lost decades. This is the EKG of the Japanese economy as measured by the Nikkei 225 index. I want you to note that after a period of massive cheap liberal credit and a credit binge environments leading up to December of 1989, we've had a massive credit purge environment. The Nikkei goes from roughly 38,900 down to about 10,400 today. A substantial decline in the Nikkei index. Now, I want you to note that right here at the peak, on and about December of 89, there were 150 yen to the dollar, and today we've got, approximately 80 yen to the dollar. So, but this is a classic secular bear market with a series of higher lows and a series of lower lows. And my question to you, of course, is what happened to real estate during this period of time? Well, we saw that during this period of time, single-family homes in Japan collapsed over this 20-year period of time, 65%, and commercial real estate in many areas declined over 70%. So what was your best investment during this period of time? Well, this was a period of, and what led to this massive decline and rates of inflation. Well, gold was an excellent. But the Japanese yen, cash, and cash equivalent. And we'll look at gold as the ultimate cash equivalent here in just a moment. But of course gold was outstanding. Gold goes from roughly $300 an ounce to roughly $1,400 an ounce. But look how well cash performed relative to this particular index. You see, during periods of disinflation, deflation, during periods of deleveraging credit purge, and I'm about to show you, that happened in the Japanese economy, your number one investment was cash and cash equivalent. The fact that you were learning how to trade foreign currencies, I salute you. I think you've made the right choice. You're in the right asset class. During times of inflation, cash is trash in purchasing power parity. But during times of deflation, cash is king. And this is one of the most livid examples of deflation we've ever seen, only to be superseded as a percent of GDP was the credit purge era of the 1930s in the United States. And look how remarkably similar these patterns of bear markets were expressed in percentage price change from the 1930s to the last 2 decades in Japan. Now, you can see during this period of credit purge where the Nikkei index goes from 38,900 down to approximately 10,400 today, that we had some remarkable trading opportunities and volatility in price change in both the secular bear market roll and the cyclical back 38 is up 34, down 47, up 50, down 32, up 56, down 43, up 61, down 62, up 135, down 61, up 40. My forecast is, going forward, ladies and gentlemen, you and I are going to experience more price pattern similar to this. Now, what caused this great credit purge, and why couldn't the Keynesian government fix it? Well, let's take a look at what happened. In 1989, when this credit purge started, the private sector debt falls from 273% of GDP down to about 105% of GDP today. So by far, the largest component of debt in the Japanese economy driving that secular bear market was the credit purge that came off the balance sheets of the private sector. The Keynesian-led Japanese government does the Keynesian classic knee-jerk perception, which is to say, if the private sector is going to get in a state of demand destruction and not consume, then what we need to do as a Japanese government is a lot of deficit spending. And of course, the pattern is predictable. The Japanese government takes debt from 52% of GDP in 1989. This is a little out of date. It's over 200% of GDP, as we saw in this chart right here. So, ladies and gentlemen, what's that got to do with America? Everybody knows that since March of 2009, we've seen a great rally in the U.S. stock market. Well, we saw great rallies as well during this period of time. So what? This is a picture you will never see on CNBC, and I doubt if anybody on FX Street can find the real peaks with the Japanese inflation deflation below. This was the number of years leading up to it. There's the number of years since the peak. Now, I find, and I hope you find, a very high relative correlation of incidence here. How many of you find this pattern remarkably similar? Yes or no? Well, I do too. What do the rest of you see? So, we need bear market skills. Bear market skills for all market. And the primary glance of practice back over the last 40 years. And you can see that general consensus economic forecasts that you and I should virtually ignore, have a remarkable history over the last 40 years of not picking up any of the great volatility that we have been able to see. So let's take a look at the U.S. stock market. And I think we can learn a lot because, remember, the U.S. stock market, this is the nominal growth of the U.S. stock market in blue. Now, this is the S&P. But when you adjust it for inflation, or asking what is the purchasing power parity of the S&P going from 1880 through 2010, you can see in real terms, it's not a very pretty picture. In fact, if you're going to participate in the stock market and want real growth, there must be dividends reinvested through some kind of a tax-deferred wrapper, like a pension plan. Because if you just look at the price change, it doesn't get us where we want to get. Going back to that previous chart we looked at of the Dow compared to the S&P earlier, you can see from 1900 through 1982, in real terms, the Dow is virtually lower than it was in purchasing power parity in 1900. And I assure you, the mutual fund industry is not going to show you a chart like that. Now, I've been an advocate here at Online Trading Academy for increased exposure to gold since the first quarter of 2000. And I'm on record. I've got a series of webinars at FX Street that are archived under my name. Just go back and look at them. You can see how we've been strong advocates of you increasing your exposure to gold. And we've been very bullish on gold. And I'm still very bullish on gold because of this chart right here. And this is the price of gold relative to the S&P. And what this chart is asking is how many units of the S&P does it take to buy 1 unit of gold? And you can see it has been all over the board. It's been from roughly a half an ounce of gold all the way up to 6 units of gold, or 6 units of the S&P. So you can see that since 1928, the gold S&P ratio has been all over the board. At the bottom of the credit purge of the 1930s, it took, remember, from 1928 through 1971, we were on a gold standard. That is, our dollar and many currencies across the world were convertible into gold at a fixed ratio. So let's take a look at this period right here, which was the bottom of the credit purge of the 1930s. We saw that it took, in June of 32 through March of 33, gold was priced at 4.5 times the value of the S&P. And that was one of the extremes. The other was in January of 1980. But then we got back to some normalcy, and we saw it plunge. In other words, this is, in essence, a bull market in the S&P relative to gold coming out of the Great Depression, all the way through 1971. In 1974, we see that gold was priced at 2.7 times the price of the S&P. Now, let's assume the S&P today is at about 1,300. If I were to take 1,300 and multiply it by 4.5, that's about where gold should be priced in an environment of serious credit purge and uncertainty. In 1974, if the S&P were at about 1,300, you'd multiply it by 2.7, and that's where the price of gold should be in an era like this. But take a look at January of 1980. That's when we had that gold blow-off at $850. You know, gold went from $42 to $850. That was an incredible bull market starting in 1971. But note that in that era, gold was priced at 6 times the price of the S&P. So somebody do the calculation. The S&P is at 1,300 and gold is priced at 6 times 1,300. What would that put the price equivalent of gold at today? Somebody do the math. Then we had this great bull market in equities. And we had a 20-year bear market in gold, all the way into 2000 bottom. And here's where we are today. Today, the price of gold is at about 1,400, and we have the S&P priced at about 1,300 and change. But ladies and gentlemen, I'm going to show you what my forecast is for gold. I think we're going back to the average, and the average is right here at about 1.5. Okay? About 1.5. So let's take 1,300 and multiply it by 1.5. What do you come up with? Because that becomes my forecast for gold. What do we know about markets? We know that markets are mean reversion animals. That's what we know about markets. They're mean reversion animals. And the average is 1.5 times the price of the S&P. So if we take 1,300 times 1.5, my forecast for gold is 1950. And today gold is trading at 1,400 and change. Now, how does that compare to the historical constant dollar of gold? Well, in black, we have the nominal price of gold going back to 1980 at 850. And if we were to adjust gold back for inflation to its purchasing power parity equivalent of 1980, gold today, to have the same purchasing power that 850 had in 1980, needs to be trading at about $2,359 an ounce. So I don't think my 1950 forecast is too extreme, given that gold has been as high as 6 times the price of the S&P, 2.5 times the price of the S&P, and 4.5 times the price of the S&P under non-strenuous conditions. Now, what do we know about our economy? We know that our economy, since 1945 in green, has had real GDP growth. And we know that the GDP growth has been in real terms relative to debt to the GDP ratio. We saw that in the previous chart. But we also know that even in these, and we saw in the gray bars in the background here, periods since 1945 where we've had several recessions. And we know what happens in recessions. In many cases, we get stagnant or we get negative real growth. But I want you to keep in mind that, the economy grows in real terms at about 2.2% per annum. So if you're looking for dramatically growing GDP rates like China experiences at 8 to 10%, it's just not in the cards. Our economy is too large, and there's nothing like that in the historical data that would support we're going to have, great growing growth rates when in fact the average can vary somewhere between 2.2 and 3.3%. So let's talk about an important man in history, economic history. Some of you may have never heard of John Mills. You can go to Wikipedia and look him up if you'd like. But he asked a very important question in the early 1800s. And that question was, do panics and crashes destroy capital? So I'll ask this room that same question. Do panics and crashes destroy capital? Yes or no, class? Well, John Mills had this to say about it. Financial panics and crashes do not destroy capital. Now, that may be a surprise to Lehman Brothers and Bear Stearns and AIG and Fannie and Freddie, but panics and crashes merely reveal the extent to which it has been previously destroyed by its betrayal and hopelessly unproductive works. My examples of this are Greek debt, Lehman Brothers, GM, Chrysler, Fannie, Freddie, Bear Stearns. Okay? That's what destroys capital. My example is GM. When we finally opened up the belly of the beast of GM and got some transparency and saw how grossly disformed their business model was, we saw that they had been insolvent for almost 20 years. It's easy to understand why they collapsed under their hopelessly unproductive business model. Same thing with Fannie and Freddie, same thing with Lehman Brothers, Bear Stearns, and the same thing with socialism in Western Europe. The problem with Greece, ladies and gentlemen, and the problem with socialism in general is sooner or later you run out of somebody else's money to borrow and spend. Now, This is one of the most crisp statements I think you're ever going to get. You know, our nation faces the most severe financial crisis since the Great Depression, said Timothy Geithner about a year ago. He said it's a crisis of confidence, of capital, of credit, and of consumer demand. This is probably the most crisp articulation of the challenge we face I've ever seen. And I think you and I really need to keep this in perspective, that there is an evolving world saver confidence challenge. Private families and private entities across the world are deleveraging their balance sheets, some voluntarily, some involuntarily, at an accelerated rate. And this is what's caused the global imbalance of trade and the global general slowing of the global economy. Now, it's my position in this presentation today that this is a trend that we're going to continue to experience for the rest of this decade. It's going to take a significant time to delever, reposition, and recapitalize both private and public balance sheets across the world. And I hope you are understanding that in this process, it can be quite impactful in volatility on the price of all assets. Steve Schwartzman, who runs the Blackstone Group, one of the largest private equity firms in the world, had this to say recently on a Reuters press conference. He said between 40 and 45% of the world's wealth has been destroyed in little less than a year and a half. He said this is absolutely unprecedented in our lifetime. And what happened, ladies and gentlemen, is even though these sovereign governments are borrowing and printing money like drunken sailors, in fact, the private sectors are deleveraging their balance sheet at a much faster rate than these sovereign governments can deficit spend. And you've got to keep in mind that there are two credit bubbles out there. One where the sovereign government has a printing press and can pay their debt with printed money, and the other bubble, which is much larger than the sovereign debt bubble, is in the private sector or in the city and state local government level, and they don't have a printing press. And there's only two ways to repudiate debt. There's only two ways to repudiate debt. You either print up a lot of money and pay it off with worth less currency, or you renege and default on the debt. So let's get into the inflation-deflation debate. This is my friend CP, and CP has a lot to say about this. He's been influenced by the Austrian School of Economics. I would encourage you to visit their website. Go to www.mises.org. There's a tremendous amount of information there. This is your banker sitting on top of your money at your bank. How many of you believe this is an accurate picture? That your banker has all this money in the back of your bank? Well, there is no money in the back of the banks. In fact, the money that's in your bank has been lent out. It's in a real estate loan. It's in an automobile loan. It's in a merchant's charge card receivables. It's been lent out. And some of those loans aren't getting repaid. You know, how would you like to own some Greek debt right now? How would you like to own some Libyan debt right now? Maybe you'd like to own some Egyptian debt right now. You know, we got a lot of credit instruments that are not getting paid. And of course, the securitization window for subprime mortgages has really never reopened. It functionally closed in fourth quarter of 2008, and there's just no market for those anemic, poor credit instruments. And we're talking about trillions and trillions of dollars of orphan debt right now that's having a hard time capturing a bid. So if you follow the Austrian economic theory of business, the money supply or the purchasing power of the euro or the US dollar is driven by cash plus credit in a given system. Now let's take a look at the US. In the U.S., there's about $2 trillion of cash outstanding, but it's $50 trillion of debt. So if I look at the credit bubble of 50 trillion, which is 3.5 times the size of GDP. Of the 50 trillion, only 12 trillion of that is federal debt. 38 trillion is not federal debt and cannot be paid with printed money. I want you to keep that in mind. So what's the most important component of the credit component of the money supply? Well, it's credit, because it's a 25-to-1 ratio. Now, here's the history of public debt in America going back to 1932. Debt percent of GDP went over 100%, but we paid that down. We paid that down by raising taxes and growing our economy. And these are the forecasts on the hard right edge of where we're headed today. Forecasts are, we're going to take existing debt from where it's at today to about 19 trillion. Now, the history of debt looks like this, and a lot of debt, of course, was generated during World War II, but we paid most of that down, and it really didn't matter which president was in power. Both presidential parties, or dominant parties, have a remarkable similar track record. But today, here's what the picture looks like. We looked at this earlier. Debt as a percent of GDP is up around 369% of GDP. And I believe we are going to purge a substantial percentage of this private debt out of the system. But let's define our terms, because we're supposed to have an inflation-deflation debate. First of all, inflation is a process. It's not an event of a higher price. A higher price to inflation is like saying, wet streets cause rain. Wet streets are the end result of the rain process. Well, a higher price is the end result of the inflation process. According to Webster's dictionary, inflation is an increase in the volume of money and credit relative to available goods. Now that's crisp. That really allows you to get your arms around the importance of that credit component of the money supply, which is the 25-to-1 ratio. Now, Keynes, who came out of Cambridge in the 1930s, was an incredible advocate of the inflation process. And he wrote in a book, The Economic Consequences of the Peace, in 1919, and I pulled this excerpt. He said, quote, by a continuing process of inflation, which we just defined, government can confiscate secretly and unobserved an important part of the wealth of their citizens. And I believe there's a moral hazard to this. And I think the moral hazard has been expressed for decades now throughout the developed world, and the chickens are finally coming home to roost, and we're all going to have to pay the price, unfortunately. Now, projected deficits run all the way out through 2019 to be multiple trillions of dollars. And it's very easy for you and I to focus on that and assume that that's the most important part of the credit market. Well, it's not necessarily. Yes, we're going to have continued national deficits. And of course, it's going to, in many ways, reduce the purchasing power parity of the U.S. dollar. And we've seen that in this chart going back from 1933 through 2009, is that the U.S. dollar, through this decades of inflation process, has reduced the purchasing power parity of the U.S. dollar 94%. And note that most of that transpired after the Bretton Woods Agreement broke down and Nixon took us off the gold standard in 1971. Now, I channeled George Washington. I showed him this chart. I also showed George Washington this picture, and he told me that he wanted me to redesign the U.S. dollar. So what do you think about that? Do you think that would be a good picture? You think we ought to just go ahead and redesign the front of the U.S. dollar? Maybe old George could sleep a little bit better. I want to give you my inflation. Inflation is when you pay $15 for the $10 haircut you used to get for $5 when you had hair. Now, for all the follicle challenge men in our audience today, you can really relate to that. But let's define deflation. Let's get back to our debate. Rarely do people who get into this debate ever define their terms. Quite frankly, I found that most of the pundits on TV grossly misuse the term inflation and deflation, because deflation, in fact, is a process also. And this is how it transpires. Deflation is a contraction in the volume of money and credit relative to available goods. Now, that's the most accurate definition, and once you get your arms around the importance of that total credit component of the money supply, especially that component that is so much larger in the private sector than the sovereign debt sector, you can understand why credit can be purged off the balance sheets, and we have, in fact, contraction. And the dollars that are left over actually end up with more buying power. So falling prices, ladies and gentlemen, let me ask you a question. As a symptom of the deflation process, doesn't it take less dollars today to buy a home in your neighborhood than it took, say, 2.5, 3 years ago? Or if you live in Europe, doesn't it take less euros today to buy a home in your neighborhood than it did a few years ago? Yes or no? Come on, class. Yes or no? Yes. And doesn't that mean that your currency, your fiat currency, is growing in buying power? Now, in the United States, 48% of the consumer price index is the price of housing. The consumer price index is loaded toward housing. Not food, not energy, housing. And that's why, ladies and gentlemen, there isn't a lot of inflation as measured by the consumer price index. By far, one of the very largest costs of living in your income statement and my income statement is housing. Not food, not energy. Now, that may depend on where you live in the world, but that's the way it is in the developed world. So deflation then, falling prices, which are symptoms of deflation, a consequence of this deflation process, is symptomatic of debt destruction, bankruptcy, banking contractions, and other manifestations of deleveraging and net credit purge. And change in social mood and appetite for risk. Let's take a look at the sovereign debt crisis. The sovereign debt crisis is alive and well today. Greece, Ireland, Spain, Portugal, Italy. We're going to revisit the sovereign debt crisis this summer. What we're seeing in America is total debt is shrinking. We're seeing this in long bond yields today, 10-year paper being around 3.5%. We're in a deflationary trend. We're seeing in blue that M3 is literally collapsing. That is the credit being purged off the balance sheet. What other symptoms do I see? Bank credit as a percent plus commercial paper year-over-year change, plummeting from a positive 12% to a negative 7%. Compare that to the Great Recessions and credit purge of the mid-'70s. Ladies and gentlemen, we're seeing that demand for credit is shrinking. We haven't seen this for a long time, but it is what it is. And I get this data from the Federal Reserve System. I'd like to end on this chart, which is my forecast through 2015, is that bank credit as a percent of GDP is going back to the red line. See, bankers have changed their appetite for risk. Borrowers have changed their appetite to borrow and consume. Now, you can see from 1950, there were periods where debt as a percent of GDP was below 36%, skyrocketed all the way up to 166%, and the red line, which is 44% of GDP, is the average. And what do we know about markets? We know that markets are mean reversion animals. So to go back to the red line would be very realistic. We see the net effect is the velocity of money is shrinking. And ladies and gentlemen, that's my case for deflation. Now, I know you may be on the other side of that debate, but I hope after looking at the evidence, you have a pause for thought. I'd like to encourage you, ladies and gentlemen, to email me, john@tradingacademy.com. I have a whole series of webinars I have produced on this topic if you'd like more details. I've enjoyed being with you today. And tune in to powertradingradio.com. Monday through Friday, we broadcast live, and we'll keep pushing this topic forward. And, of course, if you go to the website, you will also see, ladies and gentlemen, 180 hours of archived content. And we're very grateful for FX Street to distribute our radio show as well. God bless you all. Good luck. I've enjoyed being with you.